Okay, so look, everyone is fixated on AMD's 38% year-over-year revenue bump, but you zoom in on just the last 3 months, and growth actually hit a brick wall, like literally 0% quarter over quarter.
Well, negative 0.1% if we are being completely precise.
Okay, fair. Welcome to Earnings Unscripted, where we try to figure out why the market cheers for a stalled engine. It is Tuesday, May 5th, 2026, and we are digging into the Q1 print for AMD.
Yeah, the tape is genuinely wild today because revenue is completely flat sequentially at $10.25 billion. That is basically identical to Q4. And non-GAAP EPS actually dropped 10%, down to $137 a share. If you only glance at the top and bottom lines, you would think they seriously stumbled.
Stumbled right into a massive rally, apparently. The stock finished the fiscal quarter a little choppy, but in after hours today, it is up over 21%, pushing right near 414. Which, quick reminder, before we ruin the illusion, we are just two friends talking. This is definitely not financial advice, so please do your own research before trading. But Miro, a 21% pop on flat revenue? What is Wall Street actually seeing here?
They are buying the future physics of the company. The underlying mix just shifted entirely. Data center revenue was up 7% sequentially to almost $5.8 billion. It literally carried the entire business on its back because the traditional consumer segments are really dragging right now. Client was down 7%. Gaming fell 15% quarter over quarter to $720 million.
Which makes sense, right? People are spending all their cash on groceries, maybe not upgrading their gaming setups right now. But what really surprised me was they still printed a record free cash flow, $2.57 billion. That's up 23%. So they have a mountain of cash, but I don't know, operating income fell 11%, margins slipped. It feels like they're pedaling really hard just to stay in place.
No, but that is exactly the core issue. They are choosing to sprint on costs. Non-GAAP gross margin dropped 2 points to 55%. GAAP was 53, non-GAAP was 55. They are funding this incredibly aggressive AI rollout. Operating expenses are basically outpacing revenue growth right now. Management admitted they're leaning heavily into R&D just to scale their go-to-market machine for these new chips.
Right. And the scale they're talking about is almost hard to comprehend. Did you catch Lisa Su mentioning Meta's deployment plan? They're targeting up to 6 gigawatts of power just for AMD-backed infrastructure.
Yeah. The physical math on that is staggering.
It really is. I mean, 6 gigawatts is roughly the power consumption of all of New York City just for AI servers. So I totally get why she revised their server CPU addressable market up to $120 billion. The narrative is massive, but it feels like the current quarter results are getting squeezed by that exact ambition.
That is the paradox here. The long-term vision is totally coherent, but the Q1 reality is an extremely expensive transition phase. And if you look closely at the guidance, there's going to be some serious margin dilution coming up to pay for all of this.
All right. Let's get into the details then, because between those OpEx bills and the new hardware ramp, things are getting really complicated under the hood.
Yeah, the complications are mostly structural at this point. Look, everyone is focused on the hype around the MI450. That is their next big flagship AI accelerator. But scaling up entirely new silicon architectures is just violently expensive.
Right, because you have to basically build out the whole manufacturing footprint before you sell a single unit.
Exactly. And the packaging complexity for these specific GPUs is off the charts. So much so that Jean Hu, the CFO, had to directly warn the street about it. I have her exact words here. She said, MI450 will start to ramp in Q3 and then ramp significantly in Q4. That is below corporate average. That will have different puts and takes in Q4 and the gross margin side.
So wait, the exact product Wall Street is pinning all the growth hopes on is actually going to pull down their corporate margins right as it peaks?
Yes. They're explicitly accepting lower unit economics in the short term. They have to, just to cement their market footprint against NVIDIA.
Which makes sense if you are the challenger. I mean, you kind of have to pave the road with your own profit margins.
That is one way to phrase it. But they're not just giving up margins. They are literally giving away equity to lock in that footprint. Did you see the OpenAI warrant deal?
I saw the headline, actually, but I don't have the specifics in front of me.
Right. So back in October, AMD issued OpenAI 160 million warrants at exactly 1 penny per share.
Wow. A penny.
But those warrants are strictly tied to GPU purchase milestones. It's essentially an agreement saying, if you buy enough of our hardware and build on our software stack, you become one of our largest equity partners.
Okay, that is brilliant because it stops being a standard vendor relationship. You are turning the most important AI developer in the world into an investor who literally benefits when your stock goes up.
Precisely. It is an extremely smart feedback loop. But speaking of external partners taking a cut, there is a totally different detail from the prior quarter filings that is, well, it is honestly quite alarming.
Okay, I love when you find the alarming stuff. What is it?
So AMD makes a chip called the MI308. It is the China-compliant AI chip they are legally permitted to export. But U.S. government officials basically expressed an expectation to take a 15% cut of all revenue generated from those licensed MI308 sales.
Pause. Just to be clear, you're saying the U.S. government wants a 15% royalty just for granting an export license?
That is exactly what the filing implies. It's a direct revenue sharing model, explicitly tied to export permissions. I mean, I have never seen trade policy operate as a corporate tax at this scale.
Jeez, that redefines international trade completely. You are effectively partnering with the government just to ship a processor.
Right. And you can already see the friction in the Q1 data. Lisa Su confirmed on the call that the data center AI segment, specifically, not the whole thing, but the AI part, actually shrank sequentially. Quoting her directly, she said, in Q1, it was actually down modestly because of the China transition. We had more China revenue sequentially in Q4, and it was less in Q1.
Well, sure, if you have this massive 15% cloud hanging over a huge geopolitical market, of course buyers and sellers are going to hesitate. So they're fighting a margin war internally, paying massive infrastructure costs, and navigating literal government profit scraping.
It's entropy with better marketing. The top-line cash flow is phenomenal, but the system generating it is running hot.
So if we step back from the raw mechanics here, where does this actually leave their trajectory going into next quarter?
It leaves them staring at a massive reacceleration. Management is guiding for approximately $11.2 billion in Q2. So that is a sequential jump of roughly 9%, but year over year, that is up 46%.
Wow. Okay, so the growth story is fully intact, but is that just data center dragging them forward again?
Pretty much. They expect non-GAAP gross margins to bounce back slightly to about 56%, but look, the broader trajectory is what fascinates me here. Lisa Su sounded incredibly bold on the call.
She really did. She actually said, these results mark a clear inflection in our growth trajectory and a structural shift in our business, which honestly, you do not use the phrase structural shift lightly on a regulated call.
No, you do not. And she backed it up by doubling their server CPU market estimate. She is now saying the total addressable market will hit over $120 billion by 2030. Because this new wave of agentic AI requires massive CPU fleets just to orchestrate tasks. The traditional processor is definitely not dead.
Right, which totally flips the narrative. But I mean, they are still walking a very fine line here, because as much as the long-term vision is huge, there is a serious warning for the second half of 2026.
Right, the memory squeeze.
Exactly. Management was clear that memory costs are spiking so aggressively that it will squeeze consumer PC and gaming demand later this year.
Yeah, the data center's hunger for memory is basically acting as a tax on the average consumer. And when you combine that inflationary pressure with that bizarre 15% government cut on China sales we mentioned earlier, there is a lot of weird, unprecedented friction coming.
It really is a lot to navigate. You're competing with NVIDIA, sacrificing short-term margins to secure footprint, and pricing your own legacy customers out of the market.
It will be a turbulent ride to that $120 billion. We just need to watch if that government export tariff actually gets enforced next quarter.
Absolutely. Well, I think we have definitely given everyone enough to chew on today.
Mm-hmm. Plenty of variables for one afternoon.
Always. Thanks for tuning in, everyone. We'll catch you after the next print. By the way, if you want these earnings chats to just show up in your feed, go ahead and follow the show. Just a transparent reminder, this project is generated with the help of AI, really just testing if machines can synthesize massive corporate filings into a completely normal conversation. We would absolutely love to hear your thoughts or ticker requests, so just shoot an email to earningsunscripted@datamadness.ca or find our X link right down in the show notes.
See you next time.